Yo, what's up, guys? We're doing some analysis on AGNC Stock or AGNC Investment Corp, and right now they're yielding over 17%. In fact, they're yielding 17.02%, and they just reported earnings. So we get to do some analysis on their most recent earnings and see, is their dividend sustainable? Can they afford it? And can they possibly raise the dividend? Because if they could, that would be amazing. Who wouldn't love the monthly cash flow, 17% yearly return just in cash? So here's kind of how it's done. Here's the 2020 pandemic crash, but it used to be $12. Now we're chilling over here at 8.46%. And if you don't know what AGNC does, I'll quickly go over to their profile. To put it very simply, if you don't want to read this, the company provides private capital to the United States housing market. So they have to do with debt and lending. And it says it's an mREIT because at the top here it says it's a REIT, but it's actually an mREIT. And they also follow the rule where they have to pay out 90% of their taxable income. So that's why they have that super high dividend yield. So let's actually do some analysis and dig into the financials. And real quick, if you would, I really would appreciate if you'd hit the like button for me. It would mean a lot. And yeah, let's just dig straight into it. So first, we'll actually look at their revenue. So here's their net income. And in the most recent quarter, it was actually negative. So it's really stagnating with this company. Even if we go to the total revenue, they even have some total revenue quarters negative. And here's their balance sheet. So their market cap is $5.8 billion and they have assets of $69 billion. And it just goes up and down every single quarter. It just has to do with how many people are choosing to lend with them. Their assets go up with their liabilities as they do that. But we actually want to look at their free cash flow. This is their free cash flow right here. I actually want to scroll to the Moomoo app because for some reason Webull doesn't have the most recent quarter. So look in the top right, you'll see 2023 Q3, and they actually lost $52 million. In the quarter before that, $61 million. And that's where the $61 million is on here. They just didn't update it yet. But let's actually zoom out. So they used to make a lot. So this is their free cash flows, okay? What they're making off all the assets. And they used to make a lot, well over, we'll just call it $300 to $400 million every single quarter, sometimes more. But in the most recent 2 quarters, look at what it's done. It was negative 50 million and negative 61 million. So let's see how much their dividend cost them, because they're losing money. So their dividend cost them $243 million. So look, they used to be able to easily afford that $243 million. That follows the 90% payout rule with how much they were making. But if we go back, their dividend cost $243 million. And how much cash did they have on hand? Well, they only have $493 million of cash. They didn't make enough free cash flow, so they have to pay out the dividend from their cash pile. So if we look, $493 million of cash, if we zoom out, that's the lowest they've ever had. That, in my opinion, is really bad. Of course, let me know your thoughts on this stock. I'm just calling it how I see it. Look, this is the lowest cash they've ever had. And how much debt do they have? So $400 million of cash, and the debt just went up to $52 billion. It went up $10 billion in the most recent quarter. $10 billion of added debt, so $52 billion of debt. So that's crazy. Cash on hand of $493 million. Let's see, are they diluting the shareholder? Wow, so they're diluting the shareholders 17% year over year. 1 year ago, it was 551 million. Now it's 648. How much is that in money terms? Okay, so in the most recent quarter, they issued $106 million worth of shares. And, a couple quarters ago, it was $434 million they issued. So it looks like they're having to issue some shares on top of the dividend. So it looks like they're issuing $100 million worth of shares. Maybe they're doing that to help pay the dividend because they can't afford the dividend. So honestly, in my opinion, there is a chance that AGNC cuts their dividend. I mean, you saw the numbers just like me, depleting cash, a lot of debt. And maybe I'm valuing this wrong because I don't want to value this the exact same way I would value a REIT because it's not a REIT. So it's probably a little bit different with the lending terms. With that being said, this isn't financial advice in no way. This is just solely my opinion. So don't take what I say and go buy the stock or sell it. It's just my opinion. Yo, also, I found this really funny. You know how their dividend yield is 17%? They've diluted you 17% year over year just in your ownership. But I wanted to also show you the cost of revenue. So this isn't helping them. So this is costing them $646 million. They're at like an all-time high for cost of revenue. So anyway, let's get out of AGNC. I actually wanted to show you another mREIT. So that we can compare it to. So the one I actually wanted to compare it to is actually ticker symbol RITM. And look how the stock is done. It's actually done pretty good compared to the other stock. Obviously, it's fallen since this 2020 COVID level, but since then it's done really good, basically gone straight up. So let's do some analysis on it because the yield on this one isn't as good as 17%, but is 10%. And I believe this one's a lot safer, of course, my opinion. Let's look at the financials of this one. All right, so here's their total revenue, $1.35 billion, and their market cap is $4.76 billion. So this one is a lower market cap than AGNC. So total revenue of $1.35 billion, and obviously their net income positive every single quarter. They don't have negative net income quarters, kind of like AGNC. But let's actually look at their balance sheet. So their balance sheet is at the 80% assets to liability ratio. So it looks like that's a rule they have. So that's cool to see. But let's look at the actual free cash flow. So looks like some quarters they make over $1 billion of free cash flow. Then the next quarter it's only like a little bit, but it evens it out. If we kind of zoom out here, we can kind of see how they're doing. But let's see how much their dividend cost. So remember, some quarters they make over $1 billion. This evens it out for the next quarter, but their actual total dividend cost is $143 million. So they can afford that really easily if you average out the 4 quarters. You got to kind of average it. But if we go to their cash on hand, $1.22 billion of cash. Remember, they have a smaller market cap than AGNC, and all their like statistics look better in my opinion. And how much have they diluted you? So remember, AGNC diluted you 17%. They've only diluted you 2%. So that's really good. That's what most stocks do on average. So that's pretty good in my opinion. And if you really like mREITs, here's another one you could look at or add your watch list or just compare it to. This is Starwood Properties Trust, ticker symbol STWD. And we're not going to go into the financials on this one, but it is yielding 10.32%. So hey, that could possibly be a stock you want to add to your watch list. And here's my Moo portfolio. Thanks for watching until the end of the video. Look at how Fiverr stock did today. In my last video, I go over why I think Fiverr stock will 10x. So make sure you watch my video up here on the end screen and make sure you subscribe because I do portfolio updates on this portfolio right here. And once I buy a stock in here, I can never sell it. That's kind of like the rule I have with it. But yeah, thank you guys so much for watching. Also, hit the join button. All revenue I make on this YouTube channel will go into this portfolio. So if you want to help me out and become a YouTube member, I would greatly appreciate it.